Insolvency and bankruptcy are not the same thing, but lots of directors don't know this, and it's that misunderstanding which causes blind panic, bad decisions, and sometimes personal disaster. Now, we'll have directors call us and say, listen, I'm going to have to go bankrupt over this business failure, and 99 times out of 100 they don't. They're dealing with company insolvency, not personal bankruptcy, and those are two completely different legal worlds. Now, if you think insolvency of your business automatically means bankruptcy for you, you'll delay action. You'll make bad decisions because you're under pressure. You'll sign personal guarantees to keep going. And a lot of the times you're going to make the situation far worse. So today I'm going to break this down properly in plain English. So what is insolvency? Well, insolvency is a financial condition. It means that you cannot pay your debts as they fall due. Your liabilities exceed your assets. That's it. It's not a punishment. It's not a reflection on you as a person. It's not a criminal charge. It's not automatically personal. But that term insolvency can apply to a company, a limited company. It can apply to you as a person. It can apply to a partnership. But when directors talk about insolvency, they really mean company insolvency. Okay? So a limited company. Remember, limited company is not you. I could have Chris Worden Limited, and it's totally separate from Chris Worden, who's the director of Chris Worden Limited. Now, what happens when a limited company is insolvent? Well, once it becomes insolvent, so you're a director, you can't pay your debts when they fall due, your liabilities are more than your assets. Your responsibilities as a director, they shift. They shift overnight. I mean, before insolvency, you go into work to make money, to pay back money to you and other shareholders. Once you become insolvent, you must not make your creditors' positions any worse. You've got to act responsibly. And what that means is taking deposits of jobs that may not get finished, continually trying to rack up debts with suppliers, purposefully not paying HMRC, okay? These are things that are going to catch you out. Now, once you're insolvent, potentially, you might need to consider formal insolvency options and common insolvency processes like liquidation, administration, CVA. Now, I want you to just think about what I've just said there. Your company's insolvent, you might need to consider liquidation, administration, a company voluntary arrangement. Guess what's not on that list? Bankruptcy. Because bankruptcy does not apply to companies. Now, listen, if anything I've said so far, okay, has made you think, flipping heck, I'm worried about this, I'm worried about that, and you want some advice around business debt, go to the comment section below, fill out that form, and one of our team will call you today, okay? Free, independent, impartial advice, okay? If you don't want to call, go to another section of the homepage and put your details into a free insolvency guide. We don't want anything off you. We'll give you a free guide that'll answer all your questions, okay? What is bankruptcy is the next part of the video, because bankruptcy is different. It is a formal legal process for an individual, and it applies to sole traders. It can apply to a director of a company, but it's the director personally that goes bankrupt. It's for individuals with personal debts. It doesn't apply to limited companies. Now, what triggers bankruptcy? A person can be made bankrupt if they owe £5,000 or more, and a creditor issues a statutory demand, the debt's then not paid, and the court grants something called a bankruptcy order. And what bankruptcy means is your personal assets may be realised, okay? A trustee controls your estate, basically everything that you own. Your credit rating is going to get absolutely battered, and there potentially could be restrictions on you acting as a director, certainly while you're in bankruptcy, okay? So a company can be insolvent without you as a director going bankrupt, okay? But if you do go bankrupt, okay, if you've made company problems personal, that's the key difference. And I'm going to come on to that, right? Because there's a reason why directors confuse the two. Because when a company collapses, let's say HMRC is chasing the company, suppliers are shouting, pressure is everywhere, directors will feel personally attacked. So they think, well, I'm going to have to go bankrupt. But legally, company insolvency does not equate to personal bankruptcy unless you've signed a personal guarantee. You've got a large overdrawn director's loan account. You've traded wrongfully. That's where the lines blur. Now, let's dig into when company issues can lead to personal bankruptcy, because this is where it gets really serious. Company insolvency can spill into bankruptcy if you've signed a PG. You've signed a personal guarantee because it exists. It could be on a bank loan, could be on a lease, could be on a finance agreement, could be on a credit card. If the company fails, the lender's got to pursue you personally. And that's where potentially you could be made bankrupt. But I've done this job a long time. And you're probably there, you might have signed a PG with a supplier. You might have signed a PG with your landlord. You might have signed a PG with a Capital on Tap or Fleximize or iWalker or Funding Circle. Now, 99% of cases, all of those people that you've signed a PG with, they will come to a sensible solution, okay? Sometimes it's just as simple as the company's gone into insolvency. Yes, I'm liable for the PG and I'm happy to pay you the agreed payments every month, but I need to pay it out of a new company. Some lenders will accept a full and final settlement, and that's where you can raise a pot of money and go, listen, I'm willing to give you this if you write off everything else. One of the lenders I just spoke about, the director owed £130,000. They managed to raise £50,000 and the lender accepted £50,000 on a £130,000 debt. A lot of the time, especially if you're a director who is either going to go for a pre-pack, so you're going to put a business for insolvency and start again, or you might be going into paid work. What you might be better off doing is saying to the lender, listen, I'm going to have 6 to 12 months where things are going to be a bit tricky, a bit tight. Therefore, I need to reduce my repayment plans and we'll step it up as the business improves, the new business improves. So with PGs, you've always got options. It's only if you bury your head in the sand and don't do anything is bankruptcy going to be likely. There are lenders, by the way, as a caveat, who are a little bit more aggressive. You'll go into insolvency, they'll demand the money, and if you don't pay them, they'll go straight to a stat demand. But they are rare. Now, the second thing I mentioned is overdrawn directors' loan accounts. Now, if you owe the company money, okay, and the company ends up in insolvency, the insolvency practitioner, their job is to pursue you for it, okay? They're not doing anything wrong. I mean, you know my bugbear is, I know on day one if you've got an overdrawn director's loan account, and once I understand that, I want to make you aware of it, okay? Not everyone's like me, okay? Some people will not mention an overdrawn director's loan account until it's at a point where you can't do anything about it, right? So my business is like, listen, sometimes you can't delay insolvency, but I want you to understand as a director all the problems that are going to ensue as a result of an insolvency, including all the personal problems that are going to hit you. And one of them is an overdrawn loan account, and that's where you owe the company money. It's an asset of the business, and an insolvency practitioner, remember, their job is to advise the company and recover funds for creditors. It is not to advise you as a director, although there are some great insolvency practitioners out there that will help you. Remember, their role is not to advise you, okay? So what I do is I say, right, first of all, let's understand if you've got an overdrawn loan account. Where can we find that out? Well, please, dear God, that you've got some financial management information. I hope everyone who watches my channel has got a good bookkeeper. It's doing a monthly profit and loss and a balance sheet on Xero, QuickBooks, Free Agent, Sage, whatever it is you use. You click a button, you pull a trial balance off, and that will tell you if you've got an overdrawn loan account. Now, if you haven't got one, if you're not using accounting software, I mean, listen, you're running your business blind essentially. And you might say to me, Chris, well, in my last set of accounts, I had an overdrawn loan account. That's a bit of a bigger problem because at the moment it's unquantifiable. You had an overdrawn loan account at one day, a snapshot in the past. If you've took any money out of that business since those last set of accounts that is not salary, okay, through the payroll, it's a good chance that's going to go on your overdrawn director's loan account. What we'll do here at Director First is we'll help you understand your position really quickly, okay? And once we understand your position, we can then start to give you an idea of what it's going to look like in insolvency. Listen, if you're in £1 million house with no mortgage and you owe the company 100 grand, you're going to pay a lot more back to the insolvency practitioner than someone who's in rented accommodation with very little disposable income. In fact, if you're in rented accommodation with very little disposable income, there's a good chance that the insolvency practitioner will take the decision to write off the vast majority, if not all, of your loan. And the reason is, an insolvency practitioner is not going to spend money, okay, if there is no hope of recovery. Because remember, when they're pursuing these overdrawn loan accounts, they've got to fund legal action. And that is where you can use that to your advantage in getting a settlement done. Let's go to the other end of the scale and you're a director with a big house, you've got lots of equity, you've got investments. The reality is, even in those scenarios, an insolvency practitioner would consider a settlement. And the reason being is, bankruptcy, I don't want to scare you with that word, but bankruptcy is where they are meant to take you if you do not comply with their request to pay the overdrawn loan account. But bankruptcy is expensive and it's risky. It can take years, not to get someone into bankruptcy, but to put a director into bankruptcy and then force them to take possession of a house is years. And a lot can happen in years, and there's a lot of risk to the insolvency practitioner who will have to fund the legal action. So in most cases, you'll be able to get some type of settlement done. Now, please bear in mind, an insolvency practitioner cannot formally agree to a settlement until they've been appointed and they've done all the investigation work. Listen, we've been doing this a long time here. If you give us full disclosure, we'll give you a good idea of what that settlement's going to look like so you can start to prepare. Now, there's a thing called wrongful trading and misconduct. So I touched on it at the start. Once you become insolvent, you can't start acting recklessly, you know, taking on a load more debt, taking on people's deposits with no hope of, of actually doing the work. You know, if you become insolvent at this point and you trade on for another 18 months and you make the creditors' positions worse, that is another area where potentially action could start against you and bankruptcy could ensue. And I guess, sorry, I forgot to touch on this. On the overdrawn loan accounts, if you bury your head in the sand and you've got equity in your property, it's highly likely you'll be made bankrupt. Now, remember also personal tax debts can end up in bankruptcy, and that's if you personally owe HMRC self-assessment. You are on the hook for that. But the important reality I want you to remember is bankruptcy does not happen automatically. It happens when obviously personal liability arises, can't be repaid, but more importantly, you bury your head in the sand. Let me give you an example, right? Company insolvency, limited company owes 200 grand to HMRC, 150 grand to suppliers, no personal guarantees, no overdrawn loan account. Listen, really sad that suppliers aren't getting paid, really sad that the revenue isn't going to get paid as well, but this happens in 2026. It's really hard out there for business. The company goes into liquidation, but because the directors haven't signed any personal guarantees, they haven't got any overdrawn loan accounts, they've acted properly, there's no issues for them personally. If we go for another example of an insolvency with some personal exposure, let's say the company owes 300 grand, but the directors signed a 75 grand personal guarantee with a really aggressive lender. The company goes into insolvency, the lender pursues the director, and the director can't repay it. And that's where the threat of bankruptcy exists. And you can probably see the difference. Insolvency is about the company, the limited company. Bankruptcy is about you personally. Now, there's a massive emotional side to this, and it's not lost on me. Listen, I've been where you're at. Most directors lose sleep. They assume the worst. They avoid advice because they don't want to sort of admit to themselves. They think I'm going to tell everybody about the stuff that we talk about. All our calls are confidential. They make panic decisions because they think that the insolvency is automatically going to end up in bankruptcy, and it doesn't. But if you misunderstand this, it can actually create the thing that you're actually scared of. So this is what you should be doing now. If you're worried, okay, if you're a director under pressure, I want you to check for personal guarantees. Check your overdrawn director's loan account. Review whether the business, I'm going to dig into this point. Your business might be insolvent, right? It does not necessarily mean that you have to shut the doors. What you need to think about is, can my business ever get back on a firm financial footing within 12 months, okay? And if it can, insolvency might not be the best option. But you know what? Get advice early. Don't guess. Please don't guess. Pick the phone up. Now remember, this is the summary. Insolvency is a financial state. Bankruptcy is a personal legal process. One applies to companies, one applies to individuals. Confusing the two leads to panic, and understanding gives you some control. So if you're a UK director worried about insolvency or bankruptcy, speak to us at Director First. We'll tell you what's personal, what's company. We'll identify any real personal exposure and give you ideas of how you can deal with it. We're going to explain your options clearly in plain English, and we're going to help you act before things escalate. There is always a solution, but only if you understand the difference. Now, for me, the biggest issue that directors are facing right now that causes personal exposure is overdrawn directors' loan accounts, okay? You've probably got one, and you probably don't know that you've got one, or you don't know how bad it is. Go over there and watch that video about overdrawn loan accounts. It's going to help you understand exactly what they are, how you can find out about yours, and even give you some solutions about what you can do. Thanks for your time. Chris Worden. God bless you.